Thank you so much, Sam. We've got a lot to cover today, and really the title of the topic, Avoid Failure, is derived from the mistakes that I've heard so many custodians have made over the years in working with groups. And it often is a pretty serious problem because the employer group is often a good customer of the custodians for other reasons. And this webinar is really designed around educating the HSA custodian on how you handle an employer group and really how that's different than just a bunch of individual HSAs. And this content is going to kind of say what we're going to go through. We're going to do a lot quickly. The slides do back up some of this. But we're going to quickly do kind of a healthcare reform update that is a lot about groups, and then kind of go through some employer general issues before we get into the very specific rules for employer groups. I'm going to go through these first slides very quickly since they're only partially related to employer groups. But the first thing is the Affordable Care Act 2014 is a very significant year for the Affordable Care Act. It's really when most things take effect. And you'll notice in the middle here it says repealed. Really one of the biggest issues that was going to impact HSAs was repealed. And this is actually repealed the old-fashioned way. Congress voted to change the Affordable Care Act to get rid of this requirement that really was going to directly impact small groups. They were going to limit the maximum deductible to $4,000 for families and $2,000 for individuals. That would have had a negative impact on high-deductible health plans and HSAs because it would have increased premiums and made it less attractive. Really, nobody really too much agreed with that philosophy, so Congress agreed to repeal it. A lot of the other changes that have been made to the Affordable Care Act were kind of made by the executive branch without Congress's approval, but because that one's been repealed formally, we know it's gone. The other things that are happening in 2014 is let's go through a couple of them. The medical loss ratio has actually started in 2011. This potentially had some negative impacts to HSAs, but it basically requires insurance companies to rebate any money above, if they spend more, or if they get more than 80% of their money is not spent for healthcare dollars, anything above that, they have to give back to the employees. And if you look at the trends there, it started at 151. We're down this year. They just came out with the numbers. They're actually about zero. So really, we've gone from a relatively small amount to a very small amount. I think that the cynics would say the insurance companies have learned how to game this pretty well, so there really aren't any medical loss rebates remaining. The out-of-pocket maximums I mentioned a little bit earlier, this is an important change for high-deductible health plans. Actually, it's a change for everything except high-deductible health plans. Prior to the Affordable Care Act, HSAs required that an individual be covered by a high-deductible health plan, which for 2015 meant a family plan with a deductible of no more than $12,900. That's not the deductible. That's the total out-of-pocket cost. So the total out-of-pocket cost can't be more than $12,900, which could actually be the deductible too, but plans don't usually work that way. For a single plan, that total maximum out-of-pocket cost can't exceed $6,450. Starting this year, the Affordable Care Act requires these numbers to be the maximum out-of-pocket cost for all plans. There are some grandfathered exceptions, but basically all plans now have to meet the high-deductible health plan rules. It's a little complicated, but that's a good thing for people that want more HSAs because it used to be that quite a few plans prior to 2014 had maximum out-of-pockets above these numbers, and then the people that opened those types of insurance plans were not eligible for HSAs. Maybe a little bit more interesting and relevant to you is just how quickly these things are growing. This is a chart that's put out by Devonair, a Minnesota company that does a survey yearly, and you can just see the growth rate on this is it's a beautiful bar chart that shows that HSAs have done well really since they've been introduced, and they continue to grow very, very rapidly. The green portion is the investment. People are starting to get enough money in these accounts to want something more than just a CD or a savings account or a checking account. And that's an issue with group plans that we'll talk about in a little bit. The 2015 limits, every year the numbers change. This year they went up by $50, or this year being from 2014 to 2015 for the self-only individual, and up $100 for the family. So the family amounts go up to $6,650 for 2015. The catch-up contribution, if you're over 55, you get an extra $1,000. That's set by statute to always remain at $1,000. The other limits are also important, although custodians generally don't need to know those with quite as much detail. Jumping in now to more kind of an HSA for an employer group. Why are employers switching to HSAs? Why are they growing so quickly? And really the answer is that the Affordable Care Act requires people to have insurance, so there's some thinking that more people are buying health insurance, and the people that are buying insurance tend to buy high-deductible health plans. They are the cheapest insurance policies out there. Now, it does vary state to state, and there are variants. It doesn't have to be that way, but as a general statement, high-deductible health plans offer a cheaper alternative than anything else. And people really are concerned about health care costs. One way to address that is to buy the cheapest insurance policies, which are high-deductible health plans, and I think that's really accelerated the growth. The other reason is the tax savings. High-deductible health plans are not deductible by individuals. They are deductible by employers. But the HSA contribution is deductible by the individual. So individuals that are forced to buy health insurance because of the Affordable Care Act, 2014 is also the first year that requirement is going to be enforced, is they would probably prefer to buy a high-deductible health plan. They're not allowed to deduct that on their taxes unless they, if they run it through a company, if they're a sole proprietor. But generally, they can't deduct it, but they can at least deduct the HSA contribution portion. So from a financial perspective, it makes sense to buy a high-deductible health plan, even if it's more expensive, and then make a large HSA contribution because at least you can deduct the HSA contribution. The other reason they're growing is it really is a new approach to health care. It's not brand new. They've been around for 10 years. But for employer groups, for people looking for a change, the high-deductible health plan puts employees in a position of having a large initial deductible, but then it also gives them some responsibility and control on how that deductible is met. And there's a lot of people and a lot of studies to support that this approach works. To give individuals control over their money will also give individuals consumer-directed health care, it's called, because they'll become consumers and be better consumers with their own money. So kind of getting in more to the basics of today's presentation is, what is an employer group? This webinar is really designed for offering not one HSA at a time, but to a group. It might be a group of 10 people. It might be a group of one person. But there's different rules that apply as a custodian and as an employer and as an individual when you're doing this through an employer. So the first question is, what is a group? Well, the IRS actually doesn't define it as a group. What they say is that if an employer is going to make a pre-tax contribution for the employees, then these special rules apply. So you could have a group, and quite often you very likely will have a group of one employee. So you might have a small employer. There's only one employee that really is going to benefit from an HSA, but the employer wants to offer some pre-tax benefits to that HSA. Then these rules apply. The converse of that is you might get a large group that is offering a high-deductible health plan or is otherwise engaged with HSAs, but they're not offering their employees any real direct benefits. They might encourage their employees to open an HSA at your bank, but they're really not involved otherwise. Well, if the employer is not making a pre-tax contribution, and we'll talk more about what that is, but if they're not making a pre-tax contribution into the employee's HSA, then none of these rules apply. Now, it's still an HSA. There's still a lot of rules involved, but we're really focusing on when do these special rules for employer groups apply. Well, they only apply if the employer is making pre-tax contributions. And then what are these special rules? Well, this bullet points, we're going to spend quite a bit of time talking about these, but to introduce them, the first one is comparability. Employers that are going to give money to their employees have to do it fairly or comparably, and there's a whole bunch of rules around that. The second issue is if employers want to offer pre-tax payroll deferral, then they have to have what's called a Section 125 cafeteria plan. And the third big bucket of issues is small business owners, or depending upon the corporate structure, the